Welcome to S&P Capital IQ's monthly loan market update. I'm Steve Miller, a member of the Leverage Commentary and Data team. Over the next few minutes, we'll review recent market trends. In preview, the loan market caught fire in January as inflows far outran supply. In early February, however, conditions cooled slightly in response to rising new issue activity. Propelled by positive sentiment and muscular demand, the average price of S&P LSTA index loans climbed to a post-credit crunch high of 97.7% of par in January. As a result, the index gained 1.1%, its best performance since September. Demand hit on all cylinders in January. CLO issuance reached a fresh 5.5-year high of $9 billion. Retail inflows, meanwhile, totaled $2.9 billion, according to EPFR, the most since May 2011. Finally, managers say allocations from pension funds and other institutional investors continued. With the scales heavily weighted towards demand, it was not for nothing that new issue clearing yields fell to new credit crunch lows in January. Roughly speaking, double B loans printed in a 3% context and single Bs in a 4 to 5% range. Issuers also took advantage of strong technicals to structure 55% of new loans as covenant light. That pushed the percent of index loans with only incurrence tests to a record 30%. Another consequence of hot market conditions was a surge in repricing activity, which reached a 6-year high of $41 billion in January, with another $30 billion announced during the first 10 days of February. Switching gears, the loan market default rate inched up to 1.4% in January from 1.3% a month earlier, though it remains well inside the historical average of 3.3%. Managers expect the rate to reach 2% or so by year-end, according to LCD's latest buy-side poll. To wrap up, some final points. In early February, the market remained issuer-friendly, but some of the froth was gone. Dell's LBO was a major factor here. The deal, if completed, will include a $5.5 billion institutional tranche, the largest such execution since 2007. As a result, the all-important forward calendar of M&A-related loans ended January at $22 billion, up from $13.5 billion at year-end. The outlook for inflows, meanwhile, is mixed. While retail and institutional investors continued to put money to work in the asset class in early February, CLO issuance was slowing as narrower loan spreads nicked equity arbitrage for new vehicles. Managers generally expect a decent amount to close in February, but without a significant increase in loan supply, CLO formation could downshift considerably by March. Finally, participants expect benign conditions to prevail in the months ahead, though all the obvious macro caveats apply. That brings us to the end of our overview. For more information on the market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description below.